Disclaimer: this video is for educational and informational purposes only. The content shared does not constitute financial, investment, or trading advice.
Right now, there's a number sitting in a database at the CME Group in Chicago that almost nobody in the mainstream financial media is talking about. And if you understand what that number actually means, you're already ahead of 99% of silver investors watching right now. The number is COMEX registered silver inventory. And it's been doing something that should concern anyone holding silver or thinking about buying it. It's been falling, not slowly, not gradually over years, but in a way that, if it continues on the current trajectory, reaches a crisis point that the market is completely unprepared for. Now, before you think this is hype, before you dismiss this as another doomsday prediction, let me be clear. This is not speculation. This is not a prediction. This is documented fact. The CME publishes this data every single day. You can look it up yourself. You can track it yourself. And what the data is telling us is that the physical silver backing COMEX futures contracts is being drawn down at a pace that historically precedes major market moves. Here's what I want you to understand by the end of this video. First, what COMEX registered inventory actually is and why it matters. Second, how fast it's really declining and what the trend line is telling us. Third, what happens when registered inventory gets too low. Fourth, what's causing the drawdown. And fifth, what all of this means for you if you're sitting in silver or thinking about getting in. Let's go. The foundation of everything we're about to discuss is understanding what COMEX inventory means and why it's different from what you might think it is. COMEX, the commodity exchange, is part of the CME Group. It's the dominant futures exchange for silver in the Western world. When you see a silver price quoted on Bloomberg, on CNBC, on your brokerage platform, that price is almost always derived from COMEX futures. It's the price discovery mechanism for precious metals in the West. And every single futures contract outstanding is theoretically backed by physical silver sitting in an approved vault somewhere. Now, the CME breaks inventory down into two categories: registered silver and eligible silver. This distinction is critical, and it's where most people get lost. Registered silver is metal that's been officially warranted and is available for delivery against futures contracts. It's earmarked, it's ready to move. Eligible silver is metal sitting in COMEX vaults, but it hasn't been officially warranted for delivery. It belongs to someone. It might be an ETF holding, it might be an industrial company's strategic reserve, it might be a central bank. The owner could warrant it tomorrow, converting it to registered status, or they might hold it indefinitely. The point is, when you're talking about the actual backing of futures contracts, when you're talking about what's really available for delivery, you're talking about registered silver, not eligible. Think about that distinction for a moment, because it matters more than most people realize. When the pool of registered silver gets small, when it starts running down, that's not an academic exercise. That's a signal that the system is under stress. Now let's look at what's actually been happening. As of recent reports, COMEX registered silver inventory has fallen to levels not seen in over a decade. We're talking about dropping from peaks of over 200 million ounces down toward the 150 million ounce range, and in some months, dipping even lower. That's not a correction, that's a structural drawdown. And it's been happening consistently with occasional stabilizations, but the trend is unmistakable. To understand how severe this is, you have to understand the math of how COMEX actually functions. There are roughly 5,000 to 6,000 silver futures contracts outstanding on COMEX at any given time. Each contract represents 5,000 ounces of silver. Do the math. That's 25 to 30 million ounces of open interest. Now, not all of those contracts stand for delivery. The vast majority are rolled into the next month or cash settled. But historically, somewhere between 1% and 3% of contracts stand for delivery in any given month. That's roughly 250,000 to 900,000 ounces of delivery requests per month during active delivery months. When you have registered inventory in the 150 million ounce range, you have roughly 150 to 200 months of supply at current delivery rates. That sounds comfortable. That sounds like there's plenty. But here's the problem. That math assumes delivery requests stay constant. It assumes no acceleration. It assumes no panic. And it assumes that some of that registered inventory isn't already spoken for by other obligations, industrial commitments, or settlement requirements that aren't visible in the raw inventory number. In reality, inventory is more fragile than it looks. History teaches us this. In 2010 to 2011, during the commodity bull market, COMEX silver inventory fell dramatically. There were times when it dipped below 100 million ounces of registered metal. The reaction was explosive. Some traders who had sold short silver at lower prices suddenly found themselves unable to source metal for delivery. They had to cover positions at any price. Covering means buying, and buying drives prices higher. You get a feedback loop. Suddenly, silver wasn't trading on fundamental value anymore. It was trading on scarcity. The price moved violently. That's what physical constraints do to paper markets when the constraints become undeniable. Now, the question is, are we heading toward a similar moment? And the answer is we don't know. But the ingredients are in place. The inventory is falling. The draw is structural, not temporary. And there's a convergence of demand pressures that are pulling on that inventory from multiple directions simultaneously. Let's talk about what's actually causing the drawdown, because this is where the story gets interesting. It's not one thing, it's multiple things hitting at the same time. First, there's industrial demand. Silver is essential for solar panel manufacturing. China alone is installing solar at a record pace. Every gigawatt of capacity requires silver. Every solar cell uses silver paste. There's no substitute at scale. And that demand is continuous and structural. It's not going away. It's only growing as the world transitions toward renewable energy. Second, there's ETF inflows. When investors buy shares of silver ETFs like SLV, the fund is supposed to acquire physical silver to back those shares. That silver has to come from somewhere. Often it comes from COMEX vaults. If ETF inflows are rising and COMEX inventory is falling simultaneously, you've got demand pulling on a finite pool of supply. Third, there's China. The Shanghai premium I've documented in other videos is a signal that Chinese buyers are aggressively acquiring physical silver. That metal has to come from the global pool. Some of it comes from COMEX. When Chinese demand accelerates, the draw on Western inventories accelerates with it. Fourth, there's recycling constraints. When you melt down scrap silver, when you recycle used industrial silver, that process takes time. It requires infrastructure. It's expensive relative to the commodity price. In a tight market, recycling increases. In a loose market, it doesn't. Right now, we're in a market where recycling is being maximized because supply is tight, but there's a ceiling to how much can be recycled. You can only recycle what exists, and not all industrial silver is easily recovered. Fifth, there's mining. Global silver mine supply has been flat to slightly declining. It's a byproduct of copper, zinc, and lead mining. You can't just increase silver supply by opening more silver mines. You have to wait for other metals to be mined, and hope silver comes along as a byproduct. The mining cycle is long. It's inflexible. It doesn't respond quickly to price signals. So you've got structural industrial demand, rising ETF demand, Chinese institutional demand, recycling at the margin, and inelastic supply. That's a recipe for inventory depletion, and that's exactly what we're seeing. Now, here's what most people don't understand about inventory depletion. It doesn't have to go to zero to matter. In fact, the moment when inventory becomes visibly constrained is often before it reaches zero. The moment when market participants start to genuinely wonder if delivery is going to be a problem, that's when behavior changes. Hoarding starts. Bidding becomes more aggressive. Liquidity tightens. And once you get into that dynamic, prices can move very quickly. We saw this in March of 2020 during the COVID panic. Silver didn't run out of inventory, but for a brief moment, participants genuinely questioned whether it would. Premiums exploded. Dealers stopped taking orders. The paper price collapsed because the physical market was disconnected. When those things unhitch, when the paper market and the physical market stop moving together, volatility can be extreme. Now the question is, could we be approaching a moment like that again? Let's look at the data. COMEX registered inventory has been declining. The draw is structural. Chinese demand is visible and measurable. ETF inflows have been recurring. Industrial demand is at record levels. Mining supply is constrained. Recycling is maxed out. On the other side of the equation, what's supporting inventories? Not much. New mine supply is limited. There's no major source of secondary supply. Central banks aren't releasing metal into the market. In fact, central banks have been the biggest buyers of precious metals globally over the past 5 years. They're not sellers. The world over is long precious metals and short cash. That's not a setup that builds inventory. So we have structural demand and constrained supply. We have falling inventory. We have widening premiums in the physical market. What do you get when you combine all of that? You get a market that is increasingly fragile. You get a situation where a surprise, an unexpected demand spike, a supply disruption, or even just a moment of genuine doubt about availability could trigger a rapid repricing. Now, I want to be specific about what that repricing might look like because this is where the rubber meets the road. The repricing could be gradual. It could be a slow grind higher over months as the inventory deficit accumulates and participants slowly adjust their behavior. Or it could be rapid. It could be triggered by a delivery month where standing orders exceed available registered inventory, creating a squeeze. Or it could be triggered by an ETF announcement that they can't source silver as fast as the demand requires. Or a major industrial buyer panicking and paying through the nose to lock in supply. When paper markets are forced to reconcile with physical reality, when arbitrage breaks down because the physical constraints become undeniable, prices move. They move fast. They move sometimes violently. That's a historical fact. And the conditions for that kind of move are present in silver right now. Let me address what I'm not saying. I'm not saying silver will collapse. I'm not saying the COMEX system is going to fail tomorrow. I'm not saying sell everything and buy silver bars. That's not what the data supports. The data supports something more measured, but no less important. It supports the idea that the structural tightness in the physical silver market is real, that inventory constraints are becoming material, and that the paper price of silver may not be reflecting the true scarcity value of the metal in the actual physical market. For investors, for traders, for people who hold silver or are thinking about silver, this matters. This means that patience is being rewarded. It means that accumulating into weakness, building a position methodically rather than chasing rallies, is the right approach. It means that physical silver in hand is worth a premium to the spot price because availability is tightening. It means that the risk-reward for silver is skewed to the upside because the downside is increasingly limited by the physical constraints. Now here's what I want you to monitor going forward so you can track this yourself and not just take my word for it. First, watch the CME inventory reports. They publish daily. You can see the registered and eligible numbers. Watch the registered number specifically. If it continues declining, if it breaks below 100 million ounces, if it approaches 50 million, you're in a zone where historical precedent says major moves become possible. Second, track the premium. When COMEX silver trades at a significant premium to the world spot price, when dealers start rationing supply, when premiums on physical bars and coins spike, that's your signal that the physical constraint is becoming undeniable. Watch the spread between the COMEX price and what you actually have to pay to take delivery of physical silver in your hand. Third, watch ETF flows. If ETF inflows continue while COMEX inventory falls, that's a squeeze. Both sides are pulling metal simultaneously. That's not sustainable indefinitely. Fourth, monitor Chinese silver fund data. The Shanghai premiums I've discussed before, the fund suspensions, they all tell you about demand intensity on the other side of the world. If those premiums are widening, demand is outpacing supply badly. Fifth, read the COT report. The Commitment of Traders report, published weekly by the CFTC, shows you who's positioned where on COMEX. If commercial short positions are concentrated, if they're at extremes, if managed money is building massive long positions, that's a setup where leverage is high and a move in the price could trigger forced covering. The bottom line is this: COMEX registered silver inventory is falling. The fall is structural. It's being driven by real demand. There's no obvious source of supply to reverse it. And history tells us that when physical inventory gets tight in a traded commodity, when the physical market diverges from the paper price, the resolution tends to favor the physical market. It always does. You can print contracts forever. You can't print silver. I'm not here to tell you what to do with your money. I'm not a financial advisor. But I am here to tell you what the data shows. And the data shows a market where structural tightness is increasing, where inventory is falling, where demand is outpacing supply, and where the pricing mechanism that most people rely on, the COMEX price, may be the last thing to reflect that reality. If you've made it this far, I think you understand now why this inventory story matters. Stay informed, track the data yourself, watch the registered inventory number, and understand that sometimes the most important price signal in a market is not in the headline number that scrolls across your screen every day. It's in the inventory data, published daily, that almost nobody bothers to read. That's where the real story is. Thanks for watching. If this made sense to you, I'd appreciate a subscribe and a like. It helps more people see this content, and in a market where most of the noise is just noise, I think clarity matters. See you in the next one.